and welcome to the Build and Exit podcast. I'm Julie Wilkinson, and I'm the owner and founder of the podcast. I started it off the back of the work I do in my company, Wilkinson Accounting Solutions. We specialise in mergers and acquisitions. We act as acquisition CFOs for buyers and help people with exit planning. And I realised there was a gap in the market of financial knowledge when it comes to investment, business and entrepreneurship. So I'm really excited to have today Al Zucker. Hi, Al.
Hi, nice to be here.
Thanks for coming on. Just a bit of background. Well, I've known Al for a little while. His background is he was a corporate lawyer by trade. He left corporate and helped spearhead quite a successful startup. And I sort of moved between the two, sort of SME and back to corporate. And then also decided to walk the walk and acquired his own injector molding business in 2023. So I definitely think I was going to bring some real good experience today, because we're going to look at the differences between sort of debt and equity funding and why buyers and acquirers might choose one or the other. So first of all, I just wanted to hand over to you just to give a bit of background about yourself and why you wanted to come on the podcast.
Yeah, sure. Thank you very much. So, you've sort of summarized it quite nicely. I spent 10 years in big city law firms doing sort of larger corporate transactions, mainly involving share sales, investments, and so on. Did that for about 10 years. Found it pretty tiring, to be honest. It's a lucrative way to earn a living, but also a tough way to earn a living in many ways. So in 2020, I had a young family and decided I wanted to try something else. So I joined a fledgling startup as an exec and their general counsel, and watched that grow from 300,000 to 100 million of revenue in 3 years. Along the way, we did over 3 dozen acquisitions all over the world. It was kind of wild. And then decided I wanted to go back to practice and also do my own thing. And so, basically set up a bit of a search fund, bought an injection molder, and went back to practice. And I'm now helping entrepreneurs, startups, people in the innovation economy more generally with corporate stuff, the sorts of things we're going to talk about today.
Yeah, no, I'm interested. And I think the debt versus equity model is always interesting, because I know we spoke before about there's so many of these courses teaching people how to do no money down deals. So I think today will be good to get down to the nitty gritty really of sort of the differences between debt and equity, and maybe the risks when it comes to funding for businesses in general as well. So you've obviously worked a lot in funding and venture capitalism and areas like that. So what would your take be for like an acquirer, maybe a SME looking a couple of million deal, about the differences between when they might do equity versus debt, in your opinion?
Yeah, so I might frame that slightly differently, and rather than the when, because the when could be at any stage in the life cycle, right? I think it's more about the why and the how, and what you're really getting from each, because they're two very different funding models, and they have very different effects on what happens when you come to the end of the journey and hopefully you exit. A good way to frame this, the way I like to frame it, is to think about essentially when you who gets paid and when. If you're taking equity, you get paid last, but you get paid a share of the surplus, broadly speaking. Whereas if you take debt, you owe the money back to the bank that you borrow plus interest, usually. And that has quite a big effect on what happens. So equity investors oftentimes are much happier to take risks, because what they will do is they will place lots of bets on lots of people. Some of them will go bad and some of them will come good. And that's just part of the business model, right? So people are much more tolerant of mistakes. Banks, on the other hand, assuming that you're borrowing from a bank, but the same goes for any lender, are really interested in seeing their money back plus their interest. And so the drivers there are very different. There's also an element of control, because if somebody's seeing a share of the surplus, they're going to want a say. Whereas a bank wants less of a say. What they're really interested in is making sure that they get paid, and the controls that a bank will put in place through reporting requirements and financial covenants and this and that are really geared to making sure that the bank is able to monitor your continued solvency and ability to service that debt. And so sort of, if you go to an equity investor, you'll get a check ideally, but it comes with a certain trade-off when it comes to control and giving away a slice at the end. Whereas with a bank, it's just about paying back the money and making sure that you can service the interest and any amortization. My view is there's no right answer. Like, it's very, very deal specific. Sometimes taking equity and bringing on a partner is a really great idea because it enables you to take a bit more risk. It enables you, frankly, to do bigger deals because you can combine the two. Whereas debt obviously means that you have much more control over your own destiny at the end of the day because there's no other owner in the mix who's going to want to have some input in the direction of your business.
And in your experience, just let's talk about levels of funding. What type of control? So control basically means share ownership, doesn't it? Like what percentage of shares they take. What do you see as typical? So let's just say you're looking at a sub 1 million funding. What sort of equity do you think they'd take?
It completely depends. That's the challenge, I guess. It depends what you're buying and what you're going to do with it and how much they think the thing is worth. Because what will happen in all likelihood, this is the sort of Dragon's Den scenario, right? Where somebody walks in and says, hey, I want to set up a business selling, I don't know, pick a product, kombucha, fancy tea. I think that I'm prepared to give away 20% of my shares for £100,000 investment. And you can kind of do the maths and work out what the valuation is. The level of investment, whether you're giving away 5, 10, 20, 50, 75, like whatever, wherever you come out on that will determine what the investor wants. Because essentially, if somebody's writing you a check for 5%, that investor is expecting to be a passenger, broadly speaking. They're also expecting there to be like certain fundamental protections that means that they don't get like completely ripped off. But they're not going to expect a whole lot of input for 5%. Like, you don't get a lot of say at that point. Your founder or your main shareholder is still in control. At 35 or 40%, you're looking at a different story, and at 50%, you're looking at a very different story again. So this is one of those things where there's genuinely no size fits all. But the more you give away, as a general rule, the more control you can expect to give up, and that tends to come in sort of three main ways. The first way that you might end up giving up control is essentially by handing over a board seat. So somebody might want to sit on your board of directors and have like direct input through a formal board meeting structure. That doesn't mean they're going to come in and start doing everything, like running your business, but it does mean that they have quite a lot of day-to-day control and can actually meddle if they feel they need to. The second big way is through what are called information rights. So basically, you will be required as the company to like hand over certain information on a regular basis. It's usually management accounts on a particular cadence, which I'm sure, Julie, you've done lots and lots of over the years. Handing over your statutory accounts normally earlier than the company legislation requires them to be filed, and so on and so forth. There may be other bits and pieces of information that the investor wants. And then the third big bucket of protection for minority investors are what people call reserve matters or veto rights. And these essentially are a list of things that you cannot do without the investor consenting. And some of these are like really fundamental, like completely changing the share capital of structure of your company to sort of like squeeze them out or something. But it can often include things like material investments. So if you need to go and buy like P&E of over 100 grand, you might need to go and get sign off, whatever. My experience of doing this, sort of, if you like, entrepreneur side, is equity investors tend to be quite tolerant. They want you to grow the business because that's how they get paid. So those conversations tend to be quite easy, but you need to get into the habit of the fact that there's somebody there that you need to check this stuff with.
Yeah. And I think as well, a lot of acquirers might own a business now, or maybe they've acquired a business, so they've got one that they're running. I suppose if they wanted to spearhead the growth, part of it might come down to how much control you actually want, because I suppose if it's not your baby and you haven't built it. But I suppose that's where group structures and things comes in, because potentially you could have a group of companies with different, SPVs and different structures where maybe equity investors could come into certain parts of the group and not others potentially, so that you're protected in other areas. I mean, have you seen that happen, or do they?
Oh yeah,
do
for
the
sure.
equities? Because the equities wouldn't necessarily push to have a stake in the whole group if that wasn't required.
Oh, 100%. And that's really, really common. Like when I was when I was in practice before I went into the startup, I used to do those deals all the time, where you'd have essentially an entrepreneur who would. So I did a lot of these in property development, but you can do them in all sorts of things. Where you have an entrepreneur who's sort of very good at developing properties, but is quite cash poor. And well, I say cash poor in relatively speaking, because to like do a block of flats is obviously quite capital intensive. And what these guys would do is they would go to a funding partner and take some debt, yes, but also take an equity injection, and they would do it for that deal. So they would be developing a block of flats in, I don't know, pick a town, Brighton, and so they would get an investor in to do the Brighton deal, and then they do a Bristol deal, and they get a different investor in to do the Bristol deal, and so on and so forth. And then as they developed and sold them, they would return the money to the shareholders, and they would have a group company at the top, and then they would recycle those profits into the next deal.
Okay, yeah. So when we start looking at debt versus equity then, because one thing I think, if we start maybe looking at these no money down deals that these, people being taught,
one of the things that
I see often is if you can get a good deal on a business buy, which you can do, we all know you can get good, get a lot on seller financing, deferrals, whatever you want to call it. I find it interesting. A lot of people don't see it as a debt. I mean, it is a debt, but in their mind, because it's not interest or it's not coming from someone specifically, I mean, it's the cheapest debt you can get, right? But it is still a debt. And how do you think no money down deals then play into the scenario of, in general, in terms of, from your view, in terms of business buying? Like, what's your view on it?
Right. So I'm going to start by saying that I think they are possible, but you have to be really careful with them. Really careful with them. There are people out there selling snake oil. I'm not going to name any names, but I'm sure we know who they are. And it's not as easy as all that, to be honest. The big risk with a no money down deal is that your company is actually not the company that you buy is fundamentally not that resilient. One of the things that I have kind of learned the hard way is that entrepreneurs should spend more time thinking about their balance sheet than they actually do, because everyone looks at the profit and loss and goes, hooray, I'm making money. Now, the first thing is your profit and loss doesn't necessarily tell you how much money you're making, particularly if you're in a business that involves physical stuff, because of the way you record transactions involving stock. So your profit number does not necessarily reflect cash. So that's a problem. And then the second problem is that your balance sheet actually tells you how resilient you are. What you own and what you owe actually tells you, as a business owner, how much room for error you have. If you lever yourself to the eyeballs because you've taken essentially a deal on 100% debt, it's like buying a house on a 100% mortgage. Like there is not necessarily a lot of room, depending on your income, for like losing your job or whatever. And the same applies in a business context. You lose that one key customer, and it may not even be the key customer. It may be like a 5 or 6% material customer, but not the biggest person that you work with. And that may well tip you over the edge, and you may well be in very uncomfortable conversations with your seller about rescheduling that vendor finance. So, like, my view on this is they can be done, and there are scenarios where it is a good idea. Well, not a good idea, but at least it's viable. But like, you have to look at it in the totality. Everything you own needs to be factored in. So when I do these, I always look at, I do a full model, and I look at all elements of my cash flows. And look, I'm in manufacturing. It's capital intensive. So I have to think about CapEx, and I have to think about the debt. And it's the amortization profile on that debt that often moves the deal. Like 1% here or there to the bank, sure, is annoying, but like that's not what moves it. What moves it is if you can get vendor finance on 5 years rather than 3, because that's where you're going to get crushed or not.
Mm-hmm. Well, yeah, and everyone knows I bang on about the balance sheet pretty much every day on LinkedIn. So
I live on the balance sheet. My business partner finds it very funny. He always turns to the profit and loss, and I always turn to the balance sheet, and then we come back and we have a conversation.
But they come in sync, right? Because I mean, no, I could just I could sit here for 5 hours and tell hundreds of stories about the balance sheets. But like as an example, I've seen deals of people where they've got say 500,000 accruals sitting there. So this is where I talk about people being financially literate and do they actually know what the accruals mean? So basically, if something is in your liability section, it is saying either it's a deferred income and it's going to release as a sale, or you owe somebody money. So in accruals, typically you owe people money. Now I remember seeing this about 500,000, and it wasn't a massive business. I think it was about 3 million. So it's a relatively sizable number. And they were just saying, it's not true, it's not true, it's not true. Well, that then means, you're selling your business then for 500,000 less than, because if you've got 500,000 on your accruals, you put it to your P&L as a cost. And you checked a few trends.
And more to the point, any savvy buyer who's gone in and gone, right, I'm going to do a debt-free, cash-free deal with a normalized level of working capital is going to look at your balance sheet, because that's how you price, and say, right, there's a provision here for £500,000 for I don't know what, it's debt. So I'm going to slice it off the top.
And what do you do? And then the question is, what do you do with that? What decisions do you make about proceeding with buying the business? Because obviously that's a sizable number. If they can't give you the breakdown, then you've got to have good clauses in your SPA. But interestingly, so many people are coming to buy these businesses where they don't actually know what that 500,000 is. And often I have seen, I mean, if we get involved, obviously as the finance partners, we will see it. But if they bring people in later, like after the deal's closed, which I see very often,
oh man,
just kind
it's too late.
Overshadowed the 500,000. Yeah. And what they've actually done is the business hasn't paid anything for multiple months, so maybe even up to 12 months. So that doesn't mean they're not hiding chasing letters somewhere. So if you looked at maybe a few months trend, you might argue, oh yeah, it's not due, I can see on the thing, but you've got to go back further. And then I've seen it where people have gone through these due diligence, bought them, have these, and then they are actually due. They're genuine. Yeah. And yeah, fair enough. You can say, I've got a clause in my SPA. I can claw that. But what happens when you get your legal letter through the next day after you buy it, and you now owe 300,000, and you've taken all the money out and got this seller financing, and you've still got to go through that pain of
it might be terminal,
clawing that back.
It might be terminal, right? Because in that situation, if you find yourself on the like, let's just think about that as a doomsday scenario. So you've bought a business which has got a £500,000 debt. Let's say you get a statutory demand, right? So somebody's like, I'm so frustrated with you. I'm actually going to put you. I want the money in 3 weeks, or I'm going to put you into insolvency. You're now running, right? Because unless your seller that you've just handed a life-changing amount of money to has that money still sitting around and is happy to give it back, clue, they probably don't, or they probably won't, right? You're now in a situation where unless you can stave off that creditor, you might lose a lot at that point. So you have to pick apart the balance sheet. You always it is as important, if not more important, than the P&L, if not for pricing it. So the way I think about it is I price off a P&L using EBITDA, but then I adjust it by really analyzing what sits on the balance sheet. And you need to look at both. You need to look at the assets and the liabilities, right? Because that asset base is a way in which you can think about leverage. So debt, for people who are not maybe corporate finance experts, you can borrow against certain of those assets from lenders. So understanding what they own and therefore what your borrowing capacity is if you want to release a certain amount of money up front, and what they owe, which is how you're going to pay it all back, including the bank, including the vendor finance, etc., is so fundamental to doing these deals. And often on a no money down, to sort of close the loop on this, in a no money down scenario, there's no resilience. Whereas if you're putting in 20, 30, 50% yourself and then borrowing the rest, whether that's again vendor finance or debt, it doesn't really matter. You just have so much more resilience, because that equity cushion is the money that is essentially kind of knocking around, that reduces your net cash outflow and therefore enables you to deal with the shock, whether that's a lost customer, whether that's an unexpected bill, whatever.
Yeah. And in my mind, it comes down to then, when do people want to invest? in advisors helping them in the acquisition process, because a lot of people don't want to spend too much money before heads terms. So I'll go, no, I can give an indicative offer and I get to heads. But the amount of times I see the problems come when you get into due diligence, so you start checking the balance sheets and you find these problems. I mean, I've seen valuation change by way over a million, because of these 500,000. Taxes are often not on the balance sheet, because obviously you have the balance sheet numbers that are there, but that's assuming that everyone's put everything in. So, for example, trade creditors, for instance, are only there if people actually process the invoices in the first place. So if somebody, and I had someone come on the podcast a few episodes ago that said that they worked with a company that was actually 5 million in debt because someone had hidden invoices in their drawer because they didn't dare to say it because of the culture, and they didn't know. So you've got to remember that generally in finance we're taught if the balance sheet's right, the P&L's right, because ultimately there's always a double side to a transaction, and normally it's P&L and balance sheet in most occasions. But obviously if something's been omitted from both sides, so someone just hasn't put anything on and you haven't paid it out the bank because you didn't know it was due, how do you track that? And that's where then the P&L becomes important, because that's where your trends become important, because balance sheet is important for what's gone through, but how do you sense check what's not gone through? And that can often come out because that's when you check the trends. So it's what level of, in detail you're going into when you're doing your due diligence, and when's the best time to check the balance sheets. Is it before you get to heads? Or actually, should there be an integrity check of those balance sheets before you get to heads to see if there's any big numbers coming out? I would think before heads.
I can give you a view as to how we do this. And actually, well, let me start with a story, and then we can talk about maybe heads of terms. So I actually was looking at an acquisition through my holding company, which fell over recently, and it fell over on a not dissimilar point to what you've just discussed. Now, in this case, it was actually to do with property investment. So this was a business that owned its own freehold. So they were operating out of a facility. They owned the facility. The sellers had consistently basically not invested in that facility. So it's not like they sort of, if you like, kept back a sort of synthetic rent that they then invested in capex to like keep the property up. They had just not spent anything on it, and the property was a mess. Now, you wouldn't have seen that on the P&L or the balance sheet, other than the fact that basically, like, at the end of the day, cash was overstated because there was more cash than there should have been and not as much fixed assets as there should have been because they hadn't been investing in the building. But what happened was we sent the surveyor in, and the surveyor basically turned around and gave us a number to do year one repairs that was equal to the amount of cash that was surplus. And so we were like, hang on, guys, that cash that we thought we were paying for, and you thought we were paying for, we're now not going to pay for, because we're not going to get it and you're not going to get it. We've got to sink it into the building. And it was one of a number of things that ultimately created the deal. So I guess the learning here is, like, for us was certainly like, yes, you want to get a sense check of the numbers and you want to get a feel for whether or not they look sensible, but you can't find everything, and that's why due diligence is super important. In terms of the sanity checking that you're talking about, look, I'm not an accountant, so I'm not doing the sort of level of sophistication that you've just discussed, but what we do is a sort of like wet finger in the air, and we look at it and we go, do these management accountants look well put together? Are they working with an external bookkeeper or an accounting firm to help them put together monthly or quarterly MAs? Can I look at this data and go, okay, this is something that my seller thinks is sufficiently important that they care about accuracy because they care about understanding? And can I get at least some measure of comfort from the fact that they appear to be doing this in a, dare I say, slightly grown-up way, as opposed to getting just like some random printout from zero where you have no idea whether or not, like, the numbers are accurate. So that's sort of the way we do it before heads, and like we would get a lot more nervous about the integrity of the data in the latter scenario than the former.
Yeah. And I think, because I've seen where you talk about dilapidated assets, I mean, I've seen that. I remember seeing there was something where it had like a big warehouse, and I think it was 750,000 or something it had on the balance sheet. And literally it was so dilapidated, it was not in use. So I suppose the checks you do on assets before heads logically comes dependent on whether the business is driven by asset rich. Because in my opinion, if I was going to go to heads on a business that had a large asset pool, like a property or that, I would probably ask for photos before I signed heads.
Yeah, I mean, we'd visited,
you'd
right?
look at the pictures, wouldn't you? You'd look at the pictures to see, does it look like it's worn down and they've done a lot of work on it, or whether you, and you might not know, you might get them to think, oh yeah, it looks okay because you're not the expert, and then that's just is what it is. But like in that scenario where it's 750,000, it's completely dilapidated. Logically, if you were relatively knowledgeable about the industry, you'd probably have an idea whether those assets looked sustainable based on that value, or you might be able to go and do some checks at market to see whether does it look right, potentially, if you want to put that level of work in.
Yes and no. So I think in a scenario that we found ourselves in, and I'll throw my hands up and say, look, we got it wrong and we learned a lot. Was, look, we're in the business of making stuff, and this just happened to come with a property. So we kind of wandered around and we were like, okay, this looks a bit tired, but it looks all right. Fine, whatever. It's a factory. It doesn't have to look like a dream home. But actually, when the surveyor went in and there were all these problems with the roof, there were problems with asbestos management, there were problems with all sorts of things. That like I'm not a property guy. Like I don't really know what I'm looking for, and I don't know where those issues are. So like we shocked but not surprised probably is probably the best way to put it.
Yeah, and there's nothing wrong with it because, like you say, I wouldn't know that either on a property. You do your best checks that you could, but at least you did the checks at due diligence. The amount of people that probably wouldn't have even done the checks out and would have just bought the business and not even done the checks. So at least you did the checks at due diligence and realised and could walk away.
100%. And what I would say about diligence and the term sheet, because we should probably talk about that, is when we're doing term sheets and when I'm advising clients on term sheets, I practice what I preach in this regard. I try and get as close to accurate as I can based on limited information, and then buying in a load of caveats around like the financial information and due diligence and so on, because that way you kind of you end up walking this tightrope where, look, there are people out there who will just like chuck term sheets right, left, and center, knowing that 7 out of 10 of them are going to fall over, and they don't really care. But if you don't want to get a reputation in the market as a time waster, and some industries are fairly small, certainly the industry I like to look at, everyone talks. Like I don't want to be seen as a time waster who's just like kicking tires. I want to be seen as somebody who, when I deliver a set of heads of terms, like it means that I am serious. Like it's called a letter of intent for a reason. Like I intend to buy this thing. Now, things fall over, then that's fine, right? But I go in with a pretty clear idea that I'm in it on this one, and that's the point at which I will start spending. The trick then is like to phase stuff. So you don't want to pile into all due diligence work streams at once, rack up a load of costs for then something to like pop up in one of them. You want to sort of sit down and pause before you really start that process on the buy side and say, right, where are the big risks? Where do I think the big risks are and what matters? And then let's go hunting there first. Because like for us in this case, we started with a property because we were like, several £100,000 worth of freehold in here. We're not freehold people. We don't really do buildings. So let's go and work out whether or not this building is worth what we're being told it was worth. Turned out the answer was not. Okay, good. Like learning exercise. Okay, I'm annoyed I lost the deal, but it was a very cheap learning exercise compared to buying this thing and then having to plow all that cash into basically upkeep.
Yeah, but I'm the same on mine. So I've got a deal at the minute at heads of terms, and obviously we're buying an accounting firm, so it's not very asset rich. But we've done the same things. Like we haven't brought legals in yet. I mean, obviously we're financial experts, so we can do our own due diligence because I obviously have the team to do it. Maybe some people need their financial due diligence, but I start with the financials because my view is: does this business make any money, and will it be viable for me to buy? And if we have questions at heads of terms, we want to assess it, and can the seller give us the information? Because what I always check in my mind is if they're, so you said about this management accounts. I mean, in my experience, not many people have management accounts. They might pull one together, but they don't have them initially. And I check in my mind, are they able to be giving me this information? And you would hope accounting firms could, but to be honest, they can't often. They often can't. But anyway, regardless of the industry, whatever industry you're buying in, can they give me? Because I start to look myself like, what's my setup after I buy it? So if I want this management accounts now, I'm going to want this information after I go live. And I'm assessing in my mind not only the information that they're giving me, but what the budgets I might need afterwards. Because I like to incorporate those budgets into my numbers at first before I bring in the legals to see whether is this business sustainable for me post-acquisition before I start spending money. That's one of the things we do for people as well when we do the financial, when we do FDD for people, financial due diligence on deals, is that's what I would be looking at. Is the business sustainable after, and will it drop the value if they've maybe got a role missing or something in that business? That's what I'm looking at.
Yeah, 100%. So look, I'm in a very capital intensive space when I'm doing this personal account, and so I think about that in terms of capex. And so when I'm doing my forecast, I'm always making capex budgets, like, because it's cash out, right? And you know, it's a very lucky business that's able to turn around and say, oh well, it's just a balance sheet transaction, it doesn't really matter very much. No. Ultimately, like, if what you care about is what drops out the bottom, and because that's how you get paid, you have to think about what is happening on your balance sheet. And yeah, as I say, for me, this is capex. It's usually property, it's usually P&E, it's that sort of thing. But yeah, completely, like, there are going to be other factors if you're buying an accounting business, a recruitment business, an e-commerce business. Like, what feeds into those non P&L transactions is critical, and really, like, that is what is going to move the needle. And if you're not careful, you can be profitable and run out of money. And I'm sure you've seen that many a time.
Oh yeah, because they're spending on things like capex. That's why capex is important, because that's why your cash flow matters, because it's not necessarily your P&L. I'll tell you what I've also seen. I'm not saying people are hiding it, but where they've got linked companies. So I remember that we were looking at someone. They were starting their process, and they were looking at this business to buy, and they had a business plan, and they sent the business plan over, and the business plan said the staffing and the total costs. So when we went to the sense check, we went back to the P&L and just checked, well, what's the yearly salaries based on the business plan? And it was like £60,000 different a year. So I'm like, that's quite a bit, probably one role at least, maybe two, depending on the thing. So we went back and just said, well, I thought they said the roles were all fully, none of them were vacant. So you would expect the number to match. And it turned out there was a whole nother business, and the role was in the other business, and there was all these overheads in this other business that was maybe not linked as a group structure, so it wasn't necessarily a share structure issue. But what happens to these people and these costs once you bought the business? And yeah, it was just a whole other company that no one had even mentioned about that came into the woodworks, and then we just found that because the salaries didn't match from the business plan to the P&L.
This is small business M&A, right? Because, like, if I think about how that would have looked in my old life as a corporate lawyer, with stuff that's like big enough that it requires audit, that's a related party transaction. That's disclosable. There will be notes in the accounts, and if you're doing it properly, there will also be some measure of payment, like a management recharge or something, for those services at cost plus 5-10%. You'd go and get a study done, right? So in my old world, I'd look at that and go, well, this isn't a problem, because it's kind of a wash, left pocket, right pocket. Like, okay, it's all UK. The taxes will be paid in roughly the right amount in the right jurisdiction. Like, whatever, man. Like, but when you get into this world of SMEs, like, this is stuff that, like, people can get away with because it's not being audited, and ultimately, like, nobody is accountable. And so you have to check this. You have to check this stuff in a much, much more granular level of detail than what I was used to doing when I was doing, like, upper mid cap and large cap deals.
Yeah. Oh, I think it's hilarious sometimes. And I do feel sorry for people, because I feel a bit sorry for the sellers as well, because it's just this world of, because no one needs to be audited. And to be honest, audits don't always pick it up anyway. I mean, I used to work in audited companies, and you can hide anything from an audit. Not that I would, obviously, but you could. But anyway, and it's just. But sometimes in these SME businesses, and I don't always think the seller's doing it intentionally. I don't necessarily think people are trying to manipulate and forget. They honestly just don't even know. Like, they have no idea that they've got the 60,000 cost that hasn't gone through the business they're selling, so their business is now overvalued. They just have no idea. So yeah, this is why you have to be careful.
My starting point on a lot of these things is most people are not dishonest, and so what you're looking at is usually as you say, naivety, lack of understanding, and so on, rather than some sort of, like, nefarious activity, all the way up to fraud. Like, that is it does happen. I have seen deals where like I've done deals where like we found literal smuggling after closing, but that's very much the exception, not the rule. And but then that then leads to a really painful conversation with your seller, because let's assume you're looking at 3 times EBITDA for this business, and you've actually overstated your overhead, so your OPEX is essentially inflated by 60 grand. That's not a 60 grand price chip. That's a 180 grand price chip, and possibly more if there's like, you've then got to add the NICs and everything else and the pension contributions on top of that, right? So you could be looking at the better part of £250,000 off your deal price, because you haven't kept your books properly. And I think that's the other thing that people don't necessarily understand, is that movements on your profit and loss account and adjustments to EBITDA to actually reflect the ongoing cost of the business has a multiplier effect because of the way people tend to price.
Yeah, it's interesting. But anyway, thanks, Al, for coming on. It's been a really great episode. I think it's been really good to talk about debt and equity. And I just want to say a real big thanks to our listeners. If you like our channel, hit the subscribe button so more people can find our show. I'll see you again soon.